Hello traders, this is Blake Morrow with Forex Analytics and you're listening to the week ahead video for November 10th, 2019, the Marine Corps Hoorah birthday. So for those of you that are former Marines, well, once a Marine, always a Marine, but for those of you that are Marines, happy birthday to you. It's the 244th birthday of the United States Marine Corps, which I was happily proud to serve. Also, tomorrow will be Veterans Day. So those of you that have served your armed services, no matter what country you're in, you protected your country for freedom. Happy Veterans Day to you. Even though in your countries you might not celebrate it, but we do here in the United States. So happy Veterans Day, happy birthday, Marines. And, because of that, we're actually going to have a little bit lighter of a schedule this week. Bond markets closed actually on Monday, but we'll talk about that here in a minute. But before I go on, I do want to say if you have not tried Forex Analytics, do so. It's only $1 for 10 days. All you have to do is click this little button right here. It says sign up today. You'll see I'm already signed up, so I obviously. But if you click that button right there, it says sign up. It's you get your first 10 days for only $1. Try it out. Even if you decide you're like, I just can't really afford the monthly subscription or the annual or semi-annual subscription of the premium product, at least you can try the light product. But even if you try the light product, that's only $19 per month, and it does still give you the platform. You get the mobile device, or excuse me, the mobile app. Everything just minus a few of the features from the premiums. You still get to try out the premium product when you're trying out Forex Analytics. So it's only $1. Give it a whirl. $1 for 10 days. You can't beat that. So let's, and by the way, this is the data flash. This is for news events that are coming out. I run Bloomberg on my desktop, and the data that comes out through data flash is almost as fast as Bloomberg. So it's pretty cool. You get that with both the premium and the light product. Okay, I moved it out of the way because we're going to talk about some of the analysis here. This is the product that Forex Analytics is. If you ever want to watch a video tutorial on it, there's a couple-minute video right on our homepage, so you can check it out. But let's talk about like this next week. So, like I said, the bond market's going to be closed on Monday, so it's going to be a fairly light session in the North American session as we observe Veterans Day. There isn't a whole lot of, well, I shouldn't say that. There is some data coming out next week. Some of the key data that's coming out next week is like the CPI data out of the US. We're going to also have retail sales at the end of the week. We have GDP that's coming out in Germany. I believe that's Thursday morning, and probably is going to confirm another contraction in the biggest European country in Germany. So that's something that we're going to have to pay attention to. There's other events that are happening this week. A couple central banks are meeting, but what I really want to talk about before I even get into all that is some of the technical aspects of like, for example, the euro. I was really convinced that the euro was breaking higher. I was long. I got stopped out. I took a loss last week. It was, I was at the 111.20 level. I was very convinced that we were going to be, before we double topped here, I was very convinced that we were going to break out to the upside. We didn't. We actually did a double top. And then we broke the neckline, and now the euro actually looks like it's going down to 109.70 is where it looks like we're gonna test. I'm still in the camp that the euro dollar is basing, and or the dollar index is in the process of topping. It didn't work out the way that I expected the last 2 weeks, where I thought the euro was really going to bust a move to the upside. Even going into the week ahead video last week, I knew we were priced out at I think it was 111.50, 111.60 where we closed, and it really looked strong. I mean, we saw a lot of big reversal candles in the dollar index, and the dollar actually strengthened this week, and proved me wrong, which that's going to happen. One of the things that I always tell traders is it's okay to be wrong. I'm wrong a lot. It's just not okay to stay wrong. So, you get stopped out, you pick yourself up, brush yourself off, and look to the next trade. For me, would I be willing to buy the euro dollar again? It depends on the circumstance. Obviously, I would look for a dip below 110 is what I'm personally looking for, and to see where we're at next week, and the reasons why. If there's a reason why for me to buy the euro, maybe it is a weak CPI data on Wednesday. I might be willing to do that. One of the themes that I do want to illustrate that hasn't changed, and one of the things in my opinion that's really contained the FX market is the constant rise in the S&P. And this is I would say this is the gorilla in the room. This is the did I say gorilla? I meant elephant. This is the big elephant in the room. Gorilla, elephant, rhinoceros, whatever. It's whatever what it is. It's the S&P. The S&P continues to blast higher. I've watched a lot of traders just get run over like a freight train as the stock market has continued higher. Look, I've been thinking a few things about stocks. Obviously, I think that they're a little overpriced here. I think that they're priced for perfection, if you will. But I haven't been brave enough to step in front of the S&P in this rally. I did play, I've played the S&P on the short side a couple of times as we were, consolidating over the last year, but we're actually breaking higher, and we broke through this megaphone pattern. So many people have been looking at this megaphone pattern, but actually if you want to, talk symmetry here, if you really want to say, well, I'm looking for more of a symmetrical, a move, it might actually look something more like this. I mean, I'm just trying to be realistic. If we're doing some sort of symmetrical megaphone pattern to the lower blue trend line, it may look like that, or may even look more like that. Regardless, I think that the S&P is in process of developing some blow off top, and uh, you know everybody says, well, Blake, how far can that take us? I don't know. I mean, I honestly don't know. I do believe it's going to be catalyst related, whether it's trade deals finally signed by the U.S. and China, could be as early as this next week. We do have a NATO meeting on Tuesday, which some people expect that the U.S. China trade negotiations are going to, for phase one, are going to conclude then, and maybe that's the catalyst that everybody goes, yay, we did it, and then we reverse. I don't know, but regardless, we are grinding higher, and usually a grind turns into some sort of capitulation. In this case, it would be capitulation for shorts. We could see an accelerated move higher, maybe after the U.S. and China sign some sort of trade deal, and they decide to roll back some tariffs. And the reason why I feel this way is because regardless of the U.S. China trade deal getting done, I believe the damage in the global economy has been done. So when all the dust settles, everybody's going to go, huh, all right, well, the fact of the matter is the global economy is now slowing, maybe as a result of the U.S. China trade war that's been going on for the last year and a half. So I think that the shine's going to wear off once the U.S. China trade agreement is reached. Again, that's my working thesis with the market. Where price action goes, I'm not sure. I'm not sure if the market just completely, rallies after an agreement, or if if that marks the top, the actual top. I don't know, but obviously I'm watching price action very carefully. And while the S&P, the elephant, gorilla, uh, um, you know, whatever you want to call it in the room, the elephant in the room is the S&P. Right now, the FX market is just, obviously sideways. And will it mark a top or a bottom in the dollar, or excuse me, a bottom in the euro and a top in the dollar? I think that the S&P finally, you know, making a top probably will have an impact on the dollar. And a lot of people believe that the dollar is going to be a safe haven currency, but I'm I've been in the camp, and I'm not sure if I'm going to be right or not, because obviously we haven't seen what the market's capable of, because we haven't seen any risk off in forever. But in a risk off situation, I'm not so sure that the dollar is going to be the safe haven currency near term, because euros have been sold and deployed in the carry trade type of situation, because European rates have been at zero. So everybody's been selling euros, buying everything else. So if everybody needs to reverse that, if there is some risk aversion, the reversal might be actually selling dollars, buying euros back, and that's it's yet to be seen if that's going to be true or not. But we'll have to see, in that in that situation, which obviously isn't here because stocks continue to rally. One of the things that I'm also looking at very carefully is, if the stock market continues to go higher, what are these yen pairs going to do? If you look at the dollar yen, and Paul Franco, who's SPZ trader, that he does a couple webinars for us, for our team, and for our traders. One's private for only Forex Analytics subscribers. The other one is for general public, midday. He's talked about a lot about the dollar yen, and he feels like it should be trading significantly higher based on stocks and where the stocks are at. And I'd agree. One of the things that has really capped the US dollar Japanese yen as of late has been yields, but yields are actually starting to break out higher, which I'll pull up that chart here in a second. But you see the dollar yen, we have this big inverted head and shoulder pattern. It actually points to 114 if we break out. If we break out above this 110, big resistance zone here, right? If we break out above 110, the US dollar Japanese yen should break higher, okay? And then the question would be, where do the other yen pairs go? You have a currency pair like the euro yen, which has been consolidating very tightly below the 121.50 level, 121.60. If we break this, well, you can see it's like a little bit of a channel, but frankly, if we break above the 200-day moving average, it comes in just around 122. This could really explode higher as well. And I'm thinking along the lines, if stocks continue to rise, yields continue to go up, dollar yen goes up, euro yen could possibly power higher. And that would be the same with, like, the not just the euro yen, but you take currencies like the Aussie yen, which, as you can see, we're within striking distance of the 200-day moving average. We break above that, where are we going to extend to? Maybe 78, maybe 80 yen. That's quite possible. Now, I did mention about yield, so let's take a look at the bond market. And if you look at the 10-year, this is the 10-year bond market, which that means if bonds are going down, yields are going up. You'll notice that we punctured this year-long trend line, and we have it drawn as like channel support, but really it's just a big trend line that has been broken. And if bonds continue to go down, that means yields are going up. So watch this, like 128 level in the 10-year, a break below 128, probably take us towards the 200-day moving average, 126.15, something like that. Well, that means yields are going to rise substantially, and if that happens, you're talking dollar yen above 110. And what is, again, my question would be, what does the euro yen, what does the Aussie yen, what do some of these other yen pairs do? And that, in a rally type of situation in yields, that means bonds are going down. More than likely, stocks are really plowing higher. I want to go back, just really revisit the S&P really quick, and talk a little bit more about this. Again, I believe that once a U.S.-China trade deal gets done, there's going to be some euphoria. Whether it's a day, a week, 2 weeks, I do think that it's going to wear off after a week or two, maybe max. But in a week or 2 weeks after a US China trade deal gets done, and let's say Tuesday is the day, just for argument's sake, NATO meeting, Trump, Xi meet, they sign it, sign on the dotted line, they agree to whatever rollbacks and tariffs, whatever deal gets done, it gets done, the market explodes higher. We might have a week or two of significant squeezing in the stock market, you know. I'm exaggerating here, but we could really see it extend higher. You see the euro yen, Aussie yen, dollar yen explode higher, and then, like I said, a week or two later, everybody goes, "Hey, wait, global growth is actually slowing," and then you see the market peak wherever that might be, and then reverse, back going into the end of the year. That's kind of what I think is going to happen, you know. But I'm guessing here, just like any of you, and look, we're all entitled to opinions. I'll be watching price action, obviously very carefully upon a completion of a China-U.S. trade deal. But the one thing that I can just say between the two of us, that's you listening and me talking, is that I hope something gets done sooner rather than later, because that's going to invoke some sort of volatility in the market for sure. And that's, as traders, that's what we're all looking for. Now, I want to talk about a few things that are happening next week. Obviously we have Veterans Day on Monday, so it's going to be a fairly slow, I would think a fairly slow session, at least in North American trade once Europe goes home. But let's talk about the rest of the week. So on Tuesday, we have the RBNZ. The RBNZ is expected to cut rates. The market does know that. So the RBNZ is looking to cut. The Kiwi has been trading really heavy. You can see it's virtually all red on all of our on all of our indicators, whether it's candlestick, basic technical, harmonic, Elliott wave, and the Kiwi is trading extremely heavy. We've been, though, developing this inverted head and shoulder pattern. We still could have a little room to the downside here, maybe towards 63 cents, maybe just below, maybe 63 cents ish, and still be carving out the right shoulder of the inverted head and shoulder pattern. But what we've seen recently is it's not just about what a central bank does with rates, it's what future expectations are. So if the RBNZ cuts, but it's a quote unquote hawkish cut, perhaps the Kiwi does find a foothold, down towards 63 cents. And we continue to carve out this big inverted head and shoulder pattern. That's a possibility. I'm not trading the Kiwi. I'm just, giving you the what to look for going into this next week. Wednesday, we do have inflation data out of the US. We have CPI. Most economists are expecting CPI to tick up a little bit. I believe, that commodities are strengthening globally, which is going to feed into inflation. So watch CPI on Wednesday. That's going to be pretty important. We have also on Wednesday, we have Australian employment data coming out. And the Aussie, like I pointed out, the Aussie, I think I pointed out the Aussie yen is, really close to the 200-day moving average. You have to keep in mind the Aussie dollar is very close to the 200-day moving average. Also, big channel resistance comes in. This trend line comes in right at the same place the 200-day moving average does as well. It's around 69.40. All right. I know the Aussie, was coming off at the end of the week, but look, if we get to 69.40 and it breaks higher, think about U.S. China trade deal Tuesday, Wednesday, positive employment. The Aussie may be sitting closer to 68.50 right now, but we could be closer to 70 cents on a U.S. China trade deal and strong Australia employment. So don't get carried away thinking, oh, but look at how we closed on Friday. Yeah, I get that, but there's a lot of key developments happening this week. All right, so flip side to that is poor employment, and no China-U.S. trade deal. Maybe the Aussie does, come back down here towards support. All I have to say is 69.30, 69.40, the 200-day moving average here, super, super important and pivotal. I think it's okay to stay bearish the Aussie dollar while we're below that. Above that, yeah, I don't know if I'd want to be bearish the Aussie anymore. Like I said, Thursday we have German. It's preliminary GDP, but we're expecting, Germany to, confirm that it might be in a recession. So look for a contraction of GDP there. We have a couple Fed speakers on Thursday, and then Friday is going to be U.S. retail sales. So that's something that the market will be looking towards at the end of this next week. But guys and gals, if you follow us on YouTube, make sure you, or if you haven't subscribed to us on YouTube, make sure you subscribe to our channel. Dale Pinkert does so many great interviews throughout the course of the week. You don't want to miss those. A lot of interviews are with traders just like you and I. Some of them are with CNBC personalities that he'll spend 30, 45 minutes with interviewing. So make sure you subscribe to our channel. And if you like this video, you think it's going to be helpful to you this next week, give us a thumbs up, because my team that does all the editing and the posting of these videos, they really feel better when you give us a thumbs up. And if you like the video, also share it. Share it with other traders. Hit the retweet button on Twitter if you're following us on Twitter. And I want to wish you all a great week. And once again, if you served in the military, no matter what country you lived in, or you lived in, or live in, thank you all for your service. The world would not be the same without your service. So thank you very much. So guys and gals, my name is Blake Morrow with Forex Analytics. Have a great trading week. I'll see you tomorrow. I'll actually be broadcasting with the team tomorrow morning, even though it's Veterans Day. We're still going to do a broadcast. So I'll see you guys tomorrow morning. Have a wonderful rest of your weekend. Thanks a lot.